Welcome. Today we're covering inflation and investing. Protect your portfolio's purchasing power. Let's get started. Inflation is the silent tax on wealth. At just 3% annual inflation, the purchasing power of your money is cut in half in about 24 years. This means that money sitting in cash or low-yield accounts is slowly losing its real value, even if the dollar amount stays the same. Different assets respond to inflation very differently. Stocks have historically outpaced inflation by a wide margin over the long run. Bonds suffer in high inflation environments because their fixed payments lose purchasing power. Real assets like property and commodities tend to move with inflation. Stocks are generally the best long-term inflation hedge for most investors. Companies can pass rising costs on to consumers, growing their revenues and earnings even as inflation rises. Owning stocks means owning a share of those real business assets and future cash flows. For the portion of your portfolio in bonds, tips are worth knowing about. Treasury inflation-protected securities adjust their principal in line with the Consumer Price Index, so your purchasing power is preserved. They offer lower yields than regular bonds but provide a guaranteed real return. An inflation-resilient portfolio is mostly equities for growth, with some REIT exposure for real asset income. Keep cash to a minimum, only what you need for short-term expenses and emergency reserves. The biggest inflation mistake is holding too much cash for too long.